In this video, we're going to explore the COT, or the Commitment of Traders. So what is the Commitment of Traders? The Commitment of Traders is a U.S. federal government report that informs us what everyone else is trading. Can you imagine? What if you knew what and when all the big banks, hedge fund managers, farmers, and factories were buying and selling? Do you think that that could help you be a better trader? The Commitment of Traders, or COT, is broken down into three categories. First is what we call the commercials. These numbers represent the farmers, or producers, and the consumers, in this case the wholesalers and the factories. Technically speaking, this is the group of traders that the commodities exchanges were primarily created for. The second and third groups are the speculators, the large specs such as banks and hedge funds, and the small speculators. Prior to the establishment of central exchanges, farmers and/or producers and wholesalers and factory representatives would meet in regional locations to barter for the goods they produced and needed. As you can imagine, these central locations were chaotic and oftentimes difficult to manage and arrange a fair deal for both sides. One such story goes that a butcher went to the central bartering place to pick up a couple of piglets. Once a fair price had been negotiated, the pig farmer went into the back stall to put the piglets into a gunny sack for transport. Once the butcher, having traveled some distance, finally arrived home, he opened the gunny sack, but rather than piglets jumping out, he set free several wild cats. So it said this is where the term, "who let the cat out of the bag," came from. Additionally, in high-yield crop years, consumers or factories could negotiate an extremely low price and take advantage of the farmers and the producers. In years where crops were scarce, the farmers could take advantage of the factories and consumers. This caused both sides a lot of undue stress due to the seemingly unfair practices of the opposing party. This also, as you can imagine, caused wild price swings. Central exchanges were not only established as a convenient location to barter, but also as a protection for buyers and sellers. The exchange itself would guarantee that both parties were compensated for correct price, quality, and quantity of goods exchanged. Plus, the exchange introduced an essential key component that was able to finally bring stability to the marketplace, that being the speculator. The speculator is the grease that keeps the entire exchange running smoothly. The speculator was introduced for the sole purpose of helping the farmers, factories, and producers and consumers offset their risk of liability. For example, now at the drop of a hat, a farmer can sell his crop to a speculator whenever he wants, and doesn't have to wait until harvest, when prices are inevitably at their lowest levels. All three trading groups, commercial traders, as well as large and small speculators, open their trading accounts through a firm known as an IB, or introducing broker. We don't actually open our trading account directly with the exchange itself. The brokerage firm is our representative to the exchange. This allows everyone involved to work from a level playing field, where everyone adheres to the same exact rules and regulations, whether you're a large farmer, a bank or hedge fund, a factory, or a small speculator. Our recommended brokerage firm is Gecko Financial Services. You can find them on the web at www.geckofs.com. In the current high-tech environment, a farmer can now sell his crop with a simple click of the mouse, without the need to negotiate with any factory or consumer. And conversely, the factory owner can simply click his mouse and buy the commodities he needs as well. This is what allows each party, the farmer or the factory owner, to create a budget, get bank loans, buy equipment, and put food on the table for their families. And the best part of all, the farmer doesn't have to actually deliver the commodity until harvest time in the fall. And the factory owner doesn't have to wait until fall to find out his price. He can forward contract with the exchange, and this is why we call it the futures market. We make or take delivery sometime in the future. Again, a time specified and guaranteed by the exchange. In turn, the speculator, for their services of taking on this risk of loss as prices increase and decrease, is given the opportunity to possibly gain a large financial reward, which is all calculated and worked into the price of the commodity, which actually makes for a more stable marketplace for everyone involved. Now, by having a regulated central exchange where producers, consumers, and speculators all meet together and each party is guaranteed quality, quantity, and payment, the wheels of commerce can quickly begin to move forward. As a reflection of all this centralized trading activity, the exchanges began keeping track of what and how much each group of buyers and sellers were actively trading, and they began publishing these results to the public in a report they call the COT, or Commitment of Traders.